Let's first explain a perfect market. A perfect market is characterized by perfect competition. Perfect competition, on the other hand, occurs in a market structure with a large number of participants who have access to all required information about the marketplace and are all price takers. Prices are also determined by demand and supply. Examples of market structures demonstrating most conditions of a perfect competition include the stock exchange, the foreign exchange market, as well as central grain exchange and agricultural produce markets. A perfect market is also a market where no single buyer or seller has a noticeable influence on the price of a good. This gives a true reflection of the scarcity value of goods and services. The characteristics and conditions that result in a perfect competition include the following. Products must be homogeneous. This means that products must be identical. There should also be no differences in style, design, and quality. In this way, products compete solely on the basis of price and can be purchased anywhere. There should also be a large number of buyers and sellers. It should further not be possible for one buyer or seller to influence the price. When there are many sellers, the share of each seller in the market should be so small that the one seller cannot influence the price. In a perfect market, sellers are price takers, meaning that they accept the prevailing market price, and if they increase prices above the market price, they will lose customers. In a perfect competition, there is also no preferential treatment, nor discrimination. Collusion occurs when buyers and sellers make an agreement to limit competition. In a perfect market, no collusion takes place. Buyers and sellers base their actions solely on price, because homogeneous products fetch the same price. Therefore, no preference is shown for buying from, or even selling to any particular person. In a perfect market, there is also free competition, meaning buyers must be free to buy whatever they want, from any firm, and in any quantity. Sellers must also be free to sell whatever they want, for how much they wish, and wherever they wish. There should also be no state or government interference, and no price control. Buyers should also not form groups to obtain lower prices, nor should sellers combine to enforce higher prices. In a perfect competition, there is also free access to and from markets, meaning producers may enter and leave a market with little interference. Entering and leaving a perfect market is easy, as less capital is required, and there are fewer legal restrictions. In a perfect market, there is also efficient transport and communication. Efficient transport ensures that products are made available everywhere, while efficient communication keeps buyers and sellers informed about market conditions. This makes access to markets possible. All participants in a perfect market have full knowledge of market conditions, meaning both buyers and sellers are aware of what is happening in any part of the market. Technology has increased competition as information is easily obtained via the internet. Lastly, factors of production are completely mobile in a perfect market. This means that labor, capital, as well as other factors of production can move freely from one market to another.